Arm Holdings and Palantir Technologies have each done an excellent job capturing the rising demand for artificial intelligence solutions. But which one of these two AI stocks is the better buy today? That's what I'll answer in this video, comparing these two AI stocks on revenue, on profitability, on cash flow, shareholder dilution, and valuation, and then come to a conclusion on which one I think is the better AI stock to buy today. So let's get started with revenue.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So being that ARM Holdings has only been a publicly traded company for one fiscal year, we don't have that much data on ARM Holdings. We have a little bit more data on Palantir Technologies over the last several years. But still, in the relatively little data that we have, ARM Holdings has been growing revenue faster than Palantir, and management has told investors that they expect to grow revenue by at least 20% for several more years, at least 3 years. Next year, they're saying between 17 and 27%, and then the following 2 years, at least 20%. So revenue growth likely to continue to be elevated for ARM Holdings. Palantir Technologies also has demonstrated nice revenue growth, and given the success of its latest AIP boot camps, it's likely that Palantir's revenue growth also persists higher for longer going forward. So both of these AI companies have great revenue prospects going forward. I would say ARM Holdings has slightly better revenue prospects than Palantir, by a few percentage points, not all that much. So they're very close here in terms of revenue growth, with ARM Holdings holding the slight advantage here. The next metric I wanted to compare these two on is profit margin. And looking at these two, they're very close in this metric as well. But Palantir has demonstrated better expansion in this margin. At 12.79%, Palantir has made phenomenal progress from negative 90% in July of 2021. Now at 9.46%, ARM Holdings is also improving its profit margin, but the improvement is not as drastic as Palantir, and it's still lower than where it was a year ago. So in this metric, Palantir has the advantage, both in terms of the actual profit margin and in terms of the trending improvement in profit margin. The next metric I wanted to compare these two on is the cash flow from operations to sales. With tech companies like Palantir and ARM Holdings, you'll often see this where their cash flow from operations are significantly different than their profitability. And the main reason for that with these companies is stock-based compensation. Palantir has been known to pay a great percentage of its payout in forms of stock-based compensation. These are things like stock options and stock grants to employees, which entices employees to join the firm and work harder because they feel that they will participate in the upside of the company if their work results in success for the company. So Palantir likes this form of compensation. It doesn't need to use this form of compensation because it has plenty of cash on hand. It has roughly $4 billion of cash. So it can pay its employees cash if it wanted to, but it chooses to pay stock-based compensation as a form of incentive to get these employees to work harder than they otherwise would without that incentive. ARM Holdings also pays a good deal of stock-based compensation, but not as much as Palantir in terms of percentage-wise, and we'll see that in the next slide with shareholder dilution. But in this metric, you'll see that ARM Holdings better than Palantir at 33.71% and going in the right direction in recent quarters, whereas Palantir 28.4%, but moving downward after several years of improving this metric. They're now trending lower. I suspect this is a short-term thing and Palantir will move much higher in the future, but in the near term it may be pressured, as Palantir said that they're going to increase spending on resources so that they can meet this higher demand for artificial intelligence. Management saying that they need to invest in more resources, which means more people most likely, and other resources as well, but people is Palantir's primary resource And that's going to weigh on cash flow. That's going to weigh on profitability in the near term for Palantir. ARM Holdings, meanwhile, at 33.71%, moving higher, and with its latest V9 version of its chip design, it's likely going to move higher in the near term and longer term as well. So I highlighted that I would talk about the consequences of stock-based compensation. And the primary consequence of that is that you dilute shareholders. And when you dilute shareholders, your existing profits are split among more shares, and so your earnings per share decreases. That's the downside of using stock-based compensation. And you can see here, Palantir has diluted shareholders much more significantly than ARM Holdings. ARM Holdings has been relatively flat at about 1 billion shares outstanding, while Palantir has increased its share count from around 1.8 billion all the way up to 2.4 billion. So this is diluting shareholders and thereby decreasing earnings per share, decreasing cash flow per share. If it were to pay dividends at some point in the future, the dividend per share would be lower because the total dividend payout would be split among more shares. And so everything that goes from the total company level down to a per share level would be lower because it's now splitting among more shares. This is one of the reasons why some investors have argued against investing in Palantir stock. It's not an argument. It's not one thing that could make you say, okay, I'm not going to invest in Palantir stock because it dilutes shareholders too much. It's just one thing in the argument that bear cases make against Palantir stock. And finally, I wanted to compare these two on valuation. And the metric I chose to use is the forward price to earnings ratio. And you can see they're very closely aligned here in terms of valuation. ARM Holdings is trading at a forward PE of 56.6, while Palantir is trading at a forward PE of 54.9. So I would equate this as them being valued roughly the same. It's not enough of a difference to say that one is more expensive than the other. They're pretty much the same here. So if I was to choose between one of these two AI stocks, and before I tell you, I'll let you know that this is a very close call. This was not an easy decision to make. These two are closely aligned, as you noticed, in profit margin, in cash flow, in growth, in valuation. They're really close here. But the edge for me goes to ARM Holdings. ARM Holdings takes the slight win here in terms of which one of these two AI stocks I would prefer to buy today. The lower shareholder dilution with the better cash flow from operations and the slightly better revenue growth expectations sways me in favor of ARM Holdings as the better AI stock to buy today. But again, it's really close. It was a really close decision for me. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.